All right, let's just jump right in. If you're a founder, or really anyone in the startup world, you've got to speak the language of fundraising. And at the absolute core of that language are two terms, pre-money and post-money valuation. Honestly, getting this right is everything.
Because that's the real question, isn't it? It's the one that probably keeps you up at night. You're bringing in cash to grow, which is great, but what are you giving up in return? It's a delicate balance between fuel for the rocket ship and, well, still being the one who gets to fly it.
So here's how we're going to break it all down. First, we'll cover the basics of what your company's worth. Then we'll get into the main event, pre-money versus post-money. We'll see it all in action, uncover some of the tricky complexities, and then wrap up with the key strategic takeaways for you.
Okay, let's get straight to the heart of it. Pre-money and post-money, these aren't just jargon. They are, quite literally, the two different sides of the negotiation table. Understanding which one is being used is absolutely critical.
First up, pre-money valuation. The easiest way to think about this is it's the price tag you and your investors agree on for your company right now, as is. It's based on your progress, your team, your secret sauce, everything you've built before a single dollar of new investment comes through the door.
And the math? It's actually super simple. Your pre-money value is just the total value of the company after the investment minus the new investment itself. We'll see exactly why this is so handy in just a second.
And on the flip side, you've got post-money valuation. No tricks here. It's exactly what it sounds like. It's the total worth of your company the moment after that new funding round closes and the cash is officially in the bank.
And again, the formula is just as straightforward. It's your pre-money value plus the new cash you just raised. See? They're two sides of the very same coin. You can't have one without the other.
Now this is where it gets really interesting, because this is the psychology of the negotiation. As a founder, you're laser-focused on that pre-money number. Why? Because the higher it is, the less of your company you have to give away. But investors, they love to talk in post-money terms. It gives them total clarity. If they say, we'll invest $2 million at a $10 million post-money, they know, boom, we own exactly 20%. It's clean.
Okay, enough with the theory. Let's make this real. Let's walk through the fundraising journey for a made-up but very realistic startup. We'll call them TechFlow.
So here's TechFlow's first fundraise, their seed round. They go out, they pitch, and they agree to an $8 million pre-money valuation. An investor comes in and writes a check for $2 million. So you just add them together, 8 plus 2 gives you a $10 million post-money valuation. And the investor's ownership, that's their $2 million investment divided by that $10 million post-money value. Simple math, they now own 20% of TechFlow.
Which means, of course, that the founders, who used to own 100%, now own the other 80%. They've sold off a piece of their company to get the fuel they need for the next big push.
Now let's hit the fast forward button. 18 months later, TechFlow has absolutely crushed it. They've hit all their milestones, and now it's time for a Series A. Because they've grown so much, they can command a much higher pre-money valuation, $32 million. They raised $8 million in new capital. This puts their post-money valuation at a whopping $40 million. And funnily enough, the new investors also get a 20% stake for their money.
And this chart really shows you what dilution looks like in the real world. The founders started with 100%. After the seed round, they were down to 80%. Now, after this Series A, the new investors take their 20%, which dilutes everyone who was already on the cap table. So the founders' 80% stake gets diluted by 20%, leaving them with 64% of the company. Their ownership percentage keeps going down. But, and this is a huge but, that's only half the story.
Because while their slice of the pie got smaller, the entire pie got massively bigger. Let's do the math. After the seed round, their 80% of a $10 million company was worth $8 million. Not bad. But after the Series A, their 64% of a now $40 million company is worth $25.6 million. That is the name of the game. Own a smaller piece of something much, much more valuable.
Now, if only fundraising were always that clean and simple. Ha! In reality, there are all sorts of other things that can make the math, let's just say, a little more complicated. Let's pull back the curtain on some of these hidden complexities.
So a lot of very early-stage startups use things like convertible notes or safes instead of pricing a round right away. But these come with their own special rules, things like valuation caps and discounts. These terms basically determine how that early money turns into ownership later on, and you have to account for them.
And here is a sneaky one, a really, really important question that has a huge impact on your ownership. When you create a new stock option pool to hire amazing talent, who actually pays for that dilution? Is it just you, or is it everyone? This is a massive negotiation point, trust me. If the option pool is created from the pre-money valuation, then only the existing shareholders, that means you, the founder, take the hit. But if you negotiate for it to be created from the post-money valuation, the dilution is shared by everyone, including your new investors. Guess which one savvy founders fight for?
So what does this all boil down to? What do you really need to remember? The biggest takeaway is this. Valuation is not just a math problem. It's a strategic negotiation. So here's your checklist. 1. Have your numbers buttoned up. You need to be able to justify your pre-money valuation with real data. 2. Always, always, always clarify if you're talking pre or post-money. Don't assume. 3. Fight for that post-money option pool. And 4. Know exactly how any convertible notes are going to affect ownership when they convert.
And it always helps to understand the other side of the table. As Mike Hinckley points out, investors like post-money valuations because it's clean. It gives them certainty about what they're buying. And in the world of venture capital, reducing uncertainty is a very big deal.
And please, remember this. Getting your valuation right isn't just about winning the negotiation today. It's about setting yourself up for success tomorrow. If you raise at a crazy high valuation now, you might set a bar that's impossible to clear for your next round. And that can lead to a dreaded down round, raising money at a lower valuation, which can be absolutely brutal for momentum and morale.
You know, at the end of the day, understanding all of this pre-money, post-money, dilution, it's about more than just numbers on a spreadsheet. It's about control. It's about fairness. And most importantly, it's about setting the stage for your company's incredible future.
So as you get ready for that next pitch, remember, your valuation isn't just a number. It's a story you're telling the world about where your company has been, and more importantly, where it's going. So what story do you want yours to tell?